Hello, can we start, ma'am?
Yes, sir. Yes, sir.
Yeah.
Yes, sir.
So good afternoon, everyone. So this will be our last session on STTP at the rate of quantitative finance for portfolio management using R. And we'll cover the remaining topics that we have uh, not covered so far. And so before we start the topic, any questions from the last sessions that we have? Any specific point that you want to bring up? Nothing? Okay. So today we will cover an important aspect of investment management, which is the CAPM model. Most of you will be familiar with the CAPM model. And so just as refreshers in case like the to bring it all right now, the capital asset pricing model basically describes the relationship between systematic risk and expected return, right, for the assets, uh, for the different securities. So CAPM is very widely used throughout finance for pricing risky securities, right, and generating expected returns for the assets given the risk of the assets and the cost of the capital, right? So this is from Investopedia. This is what the capital asset pricing model uh, from Investopedia directly says, right? So we know that from our understanding of behavioral finance, each and every person has a different risk appetite, and now the risk appetite depends upon how the person perceives the market, perceives uh, or how much risk he individually can take, and what is his perception about risk and returns, right? So for everyone, this value will be different. Now, as investment management analysts, if you will say, if we are portfolio managers or we are managing high net worth individuals money, one of the most important things that we need to make sure is, in fact, the fundamental thing that has to be made sure is the returns on the portfolio must be above the average or the benchmark returns that the market has. Right now, in capital asset pricing model, it is defined by the equation risk-free rate plus beta times market risk premium, right? So beta basically is the potential investment. The beta of a investment is basically how much risk the investment will add to a portfolio that looks like the market, right? And so a portfolio is a replica of the market, and our portfolio must and should outperform the market returns. So that is the basic idea of a CAPM model. There are inherent deficiencies in the model, as we know, but then again, still it is still one of the most widely used frameworks in financial management, as we all know. So basically, what is the goal of a Quantum formula is to evaluate whether a stock is fairly valued when its risk and time value of money are compared to its expected return. Okay, so good. Now we have a brief idea about the CAPM model. Uh, there are a few other indicators, like we have the Sharpe ratio, which again is defines the premium that we expect to receive for the extra risk that we take in the market. And there are a few other financial aspects to it. Um, so with this brief background, let's go back to our studio and see how we can model a scenario, a CAPM, how we can create a portfolio using a CAPM model, uh, and we can see how it behaves vis-a-vis the market, right? So let me share my R studio with you. Stop. I was running something. Okay, good. Right. So let's say, as an investment manager, I have decided to select a few securities and I have decided to allocate some weights on the securities. Now, we know that we derive the weights from using our optimization and objective techniques that we discussed yesterday. We'll cover that once more uh, in more detail a little bit today. But let's say, as investment managers, as an initial uh, thought, I have selected four stocks and I have decided to allocate equal weights to all of them. And I want to see how it behaves vis-a-vis the market, or vis-a-vis how much returns we get corresponding to the benchmark prices. So for benchmark prices, what we will be using the S&P index. Now the S&P index directly we will not use. We will use a specific group of securities called as SPY. Now SPY is something which is a replica, or which is consists of 50 of the most coveted stocks in S&P 500, which actually represents the core of S&P 500 price movement. So any so when the market is up, the SPY prices will definitely go up. So they are the list of like 50 jewels, or the 50 best stocks that are available in the market. It is part of SPY. It is in, so it's a best 50 stocks of S&P 500. So that is what we will use as a replica for our benchmark returns. So with that thought process, let's start our our programming. The first thing that we will do is, as usual, we will import the different packages. One mode. We'll use another package called as DPLYR. So this package is again one helps us in getting some of the financial data. DPLYR. The other important library that we have is called as the performance analytics. So the performance analytics library we will use. And finally, the library that we will be using is portfolio analytics, which is also one of the important libraries that we have seen so far. So let's load them in our system. Again, in case you want to load them for you're running it for the first time, you will have to install the packages in your R environment. And we all know how you go ahead and install the packages using the tools option, and go to install package, and in the retrieve. So once the package and you have the repository grant, you can type the name of the package. Let's say dplyr, and we can see the dplyr package here. We can then just say install, in case you do not have this package in your local system. Good. Now let's create our tickers. The first thing that we do is we identify the securities that we want to invest in. In this case, the securities that I want to invest in, I have identified as my Facebook, Amazon. The next sticker that I want is Apple. So these are all the high performing stocks, not necessarily in the terms of growth, but in terms of valuation, right? We know that these companies in the short run, they will definitely not perform badly. They always have been doing pretty good. So we have identified these 5 securities for our portfolio as a fund manager. Now let's say I want to assign. The next step that I have to do is I have to assign the weights. So the weights that I want to assign, I will assign it using a variable. Let's say I will store the weights, and I want to assign equal weights to each and every of my portfolio. So 25%, there are 4 stocks, 25% each makes 100%. I want to invest the entire 100% of my investment in stocks in these 4 different securities, right? So next thing that I want to do is we want to calculate the portfolio prices as we have done. So let's calculate our portfolio prices. So so what I want to basically do is I want to store the closing prices to my portfolio prices for each one of these stocks. We have seen how we do that, right? So I want to bring in the closing price of each one of these 4 security as a column, in the column format, side by side. So the formula that we will be using a for loop for that, for ticker in tickers. Essentially, it means for each and every security in my portfolio. That is what this line means. What I want to say, I want to store these values in my portfolio prices, which I have initialized it to 0, right? So portfolio prices, I have to say, I have to bind them. So what I will do, I will bind them, column bind them. Initially, it is again portfolio prices, right? So it will come as column binding. Now the formula that we use is something called as get symbols, right? We have seen how we do that. So the formula that we use is called as get symbols.yahoo. And what we want to do here is we basically want to store the values of the tickers. The sticker values are nothing but each and every securities value. I want to define the period from where I want to get it, which is using the formula called as from. And in from, I will give the period from which I am going to get the values. Let's say I want to get the values from 2016 all the way down to today. So let's say 2016 0101. From 2016, I want to store all the values all the way down to today. I want to define the periodicity. Periodicity is means the data, how frequently I want. So let's say I want the periodicity to be daily. Every day's data I am storing, right? Means that is what we have been doing so far. The next thing that I want to do is I want to store it in my local machine. I want to bring this data in my local machine for analysis. For that, I will be using something called as auto.assign equals to F or false. Right. Now we know that we want to get only the closing prices. So I will be using something called as the column name, which is basically our closing price column name. Right. So now we have our portfolio prices. So you can see that I have given all these various different parameters inside. So let's now initialize our tickers. Um, yeah, so it got initialized. Let's create our portfolio. So now our portfolio prices have come in. If you see, Facebook's closing price, Amazon's closing price, Apple's closing price, and Netflix closing price have all been captured in our environment and in our data. Now we can use we want to apply our CAPM formula on this set of data or information that we are having, right? So let's go ahead and implement it. So before uh, even creating the CAPM formula, we also need to get our benchmark prices, right? The benchmark prices. So the benchmark prices are essentially, as I said, we will be using something called as our a specific specific benchmark index, which is defined by SPY. You can search that in Investopedia, and you will get the information about SPY. You can see the information about SPY in Investopedia if you search for it. And you can see how powerful SPY is in S&P 500. So with that, let's bring in our benchmark prices, which we will define it by benchmark prices. Which we call it as benchmark prices. So let's call again the method that we will use will not be changing, which we will call as get symbols. Oh, so get symbols dot get symbols dot Yahoo. In this, the index that we will be using is called as SPY. SPY is the index, is the name of the S&P's 50 most powerful stocks. The period will be the same from where we have got the other price returns. So let's define it was from 2016 all the way down till today. So let's call it from 2016. And periodicity will be the same as what we have defined, right? Periodicity will be equals to daily, as we have seen. Auto.assign, again, I want to bring that values in our local machine. And I want to bring in only the closing prices of my S&P 400 SPY data. So I will use something called as auto.assign equals to F. So let's see when we run it, what happens. So it created our benchmark prices. Now, if you can see SPY closing prices, and so this is your benchmark prices. So this almost simulates your market uh, as a whole, right? So we're basically talking about the US market. SPY is a S&P's most coveted stock for the US market. It's for S&P 500, right? Yeah. So the next thing that we want to do is I want to remove all the NAs in the benchmark prices because we expect, let's see if there are any. So we can use this formula called as column sums, which you can see here. You can click it, and is dot NA, no caps, is dot NA benchmark prices. Let's see if there are any. So there are no null values in our S&P SPY index. Now we have to, let's calculate our benchmark returns. The formula that again we will use will be the differential log or the ROC formula in R, we have seen, right? So benchmark returns, we will say. So benchmark returns for the S&P 500 50 most coveted stock, which is our SPICE. NA.omit, let's it's not necessary because we have seen there are no null values in our benchmark price column, but still for safer side we always use this formula. We will use the ROC formula, which is basically nothing but it's a differential log return, and we have seen the differential log return how it has been, right? Means the differential log returns. So now let's bring in what are the parameters that we need to pass is basically benchmark prices. Benchmark prices. Here I will pass another parameter which is called as type is equal to, I want to get discrete returns, not continuous. These values can be discrete or it can be continuous. I want discrete returns in benchmark returns. So let's, I can also use continuous here, but let's use discrete for the time. So let's run our, okay. So I got our benchmark returns. So these are our returns per day, all the way from 2016 till today. So each day's return, you can see it in this, right? We have stored it in our variable called as our benchmark returns, right? So what all we did so far, guys, the first thing that we did was we loaded the libraries. Then we selected our specific securities that we want to invest in, and we assign weights to these securities, which we initialized with 25%. Then we calculated the portfolio closing prices for each of these stocks and stored them in one table in column format. Right? And we use this formula to get those values. Then we selected the benchmark index uh, by considering SPY as the most closest benchmark index for S&P 500, and SPY is actually. So by benchmark prices, we have stored what are the benchmark prices for SPY in our another variable called as benchmark prices. We checked if there were any null values in our benchmark price or not, and then we calculated our benchmark returns for all of these different assets. The next thing that we want to do is we want to basically calculate our portfolio daily returns also, right? So first, let's uh, give the column names to our portfolio prices, right? So the column names to our portfolio prices, just want to initialize the portfolio prices column names. Uh, let's initialize this to the tickers. So basically, these tickers, FB, Amazon. Right now, if you see the benchmark portfolio prices, it says something like FB.close, Amazon. Just want to rename it. So if I run it, uh, if you select portfolio prices, it will be FB, Amazon. So we just rename the columns over there in order to make our calculation a little easier in the test sense. Let's plot our portfolio prices and see how it looks like. Let's take type equals to L. We will take line chart. We will use the line chart for our portfolio returns. Right? Or let's not even use it. Let the formula only decide what it is wants to do. Okay. So you can see the different stocks that we have selected, how the prices have behaved. So Facebook and Amazon's price have been almost the same, but if you see, there is one stock whose price has become increased very heavily all the way from 2016 to 2020, which is the Netflix. The red one is the Netflix, and you can see it here. So this is the portfolio prices which we have and how they have behaved all the way from 2016 all the way down till today. The next thing that I want to do is I want to calculate my daily returns, right? So the daily returns of my portfolio, of course, not the SPY. SPY is not my portfolio. I'm not maintaining SPY as a fund manager because we know that it has a fixed returns. As fund managers, our job is to maximize the returns. So we will use NA.omit. Again, the formula that we will use equals to ROC. And in this case, what we will be passing is the portfolio prices. The portfolio prices. Again, in order for consistency, I have to pass the return method that I had used in the first instance here also. So I passed my the method that we will be using for this, and the method that we passed is discrete. So I want the discrete returns from my portfolio. So as soon as I click on, I try to run this daily returns formula, I see that the daily returns I have got. So for each one of my portfolio, I have my daily returns, how they have behaved over a period of time. The next thing that I really want to do is I want to calculate my entire uh, cumulative portfolio return, right? So for CAPM, we need, and not only that, we need we are more concerned about the all the way from now till the all the way from to 2016 till date, what has been our returns. That is what we want to see. So let's calculate our portfolio return, and we initialize it with a variable called as portfolio return. The formula that we will use is called as return dot portfolio. So this is the formula that we will be using in order to convert the daily returns to cumulative returns. Right. So we have the daily returns, and here there is very important thing that I want to pass, because we are taking the portfolio return. We have to pass in the weights. What is the means contribution of each one of these individual security in my total portfolio, and then I can calculate my daily return rate. So it's something like a weighted average return for my portfolio. So let's run it. Okay, there is some on the portfolio. Acha, I'm not dying. Yeah. So portfolio return dot return dot portfolio weights. Okay, this S is missing here because we had weights. If we defined weights as, then we would have kept it as a weight. And then let's run it. Okay, very good. So now you can see you have your portfolio return object being created. So you have the entire returns on your portfolio, the, the sum of all the different portfolios, different securities that you have. You have, using the weights, you calculated the return on the portfolio. Now let's see how the cumulative returns look like. So let's chart it out actually. What we want to chart actually, we will use cumulative returns. If you see, there is something called as cumulative returns, and what we want to do is portfolio return. So let's see how this looks like. Okay, so you see that how your portfolio has given you the expected value. So something that if you had invested say 1 lakh now, at in 2016, my portfolio has given me almost like 3 times the value from that. My value of my portfolio right now is more than like 3.5 times of that value when I had invested in 2016. So if we had invested in all these stocks in 2016, we would have been like 3.5 times richer now, right? um, and these are real prices actually. These are the actual prices what the market has seen. So That is how it is. The next thing that we want to do is, let's see charts.performance summary. Let's see the performance summary of my portfolio return. Oh, right. So this gives the performance summary, like how the spikes have happened, what has been the variation, what has been the standard deviation per day returns, and then we have this drawdown chart, right? The candlestick chart, if it is, if we had taken it in the form of candlesticks. So when the markets have gone down, specifically this, you see this period of 2019 when it had gone down, when there was Jan 2019, my prices fell bit. It became almost like 0.5 times. All the way from 2019 till 2020, interestingly, it has shot from one level to another. So that is how it our portfolio looks like. Right? The next thing that we want to do is, let's calculate our, now we will calculate our metrics, our CAPM alpha, the beta, the alpha, and the Sharpe ratio, the annualized returns we will calculate. So let's calculate our CAPM beta. So we have something called as CAPM.beta. Beta is basically when the market is let's see when we calculate it. So the parameters that we will be passing are portfolio returns and the benchmark returns and the risk-free rate, right? Portfolio return, your benchmark returns, and the risk-free rate. What we want to take it is, in US, it is generally 3.5% is taken. So we want to convert it to daily. In order to convert it to daily, we want to use 0.035 divided by 252. This is generally the risk-free rate that is being used in the US market. So let's calculate it. And so it is 1.05. So beta of our portfolio is more than 1. Now let's calculate, there are two types of beta. One is in the bearish market, one is in the bullish market. So now when the market is going down, so basically how our beta is looking like, and when it is going up, how our beta is looking like. Let us see the values. So the formula that we will be using is capm.beta.bear, and the parameters that we will be passing will be the same parameters that we have passed in capm.beta. So I will just copy and I will just paste it here. And let's see how our capm beta looks like. So in the bearish market, my capm beta is slightly lower. Means I've taken care of even the risk part to a certain extent. So that is also there. There is another formula which we call as, in the bullish market, how my cap beta looks like. So when I run my beta formula in the bullish market and I try running it, let's see, it's 95.95433. So even in the bullish market, it is behaving fine. Overall, beta looks like 1.05. Bearish and the bullish market, it is slightly different. Right. Now we will also calculate, let's calculate our alpha. In R, we call it something called as the Jensen Alpha. The Jensen Alpha parameter is something that we use to get the alpha values in our portfolio. And the parameters again remain the same, which is our portfolio return, our benchmark returns, and the risk-free rate of the market. So when I run it, let's see how we get the values. Okay, so our alpha is 0.182792, not bad. It's good actually, right? Uh, now we will calculate our Sharpe ratio. Let's say our Sharpe ratio. Sharpe ratio. We have two. One is called a Sharpe ratio dot annualized and Sharpe ratio dot modified, but I'll just use just the Sharpe ratio, basic Sharpe ratio formula. So the parameters that we will be passing are our portfolio return. So the portfolio return, we see then we have to pass the risk-free rate. Risk-free rate, we have taken it as 0.035 divided by 252 per day risk-free rate, risk-free rate of return basically. We have to pass our p-value, right? The confidence interval, which is the 95% confidence interval. There is another parameter called as this one parameter is basically used to define the risk of the market, which is the standard deviation basically, right? In this case, I don't want to use any weights. My weights will be initialized to null. And then I don't want to annualize it. So let's see what our Sharpe ratio looks like. All right. So our Sharpe ratio is 0.0668472. So it is a positive, and it is more than one. Sorry, it's not more than one. It's basically uh, 0.0668472. So not bad actually if you talk about in total. Now let's tabulate our annualized returns. So I can use something called a stable.annualized returns, and let's call it our portfolio return. And portfolio return, I want to pass my risk-free rate, which is again equals to 0.035 divided by 252. Then again, that the next thing that I want to pass is let's calculate, which is fine. All right. So what is our annualized return? You can see 33% year-on-year growth, which is pretty good, which is quite above the what the SPY index has done, right? So I have been able to achieve a higher rate of return using the SPY index than the SPY index. The annualized standard deviation is 0.2759 and 1.0472. What is the if I instead of doing for the what is the benchmark returns? Let's see. So the benchmark returns have been 14.45% all the way year on year. So this is an average that we can expect a good portfolio will give. But we want to always outperform this portfolio as fund managers. Because by default, an investor will say that if your returns are very close to your SPY index, then why will they not, why they are paying you the money for doing their job of investment. Hence, but so as fund managers, we have given them more than twice the returns that what they have given, even without doing much of technical indicator analysis or other things. So this is based on the knowledge of the investor that They all do all these things. Right. So this is something called as your benchmarked return. So we calculated the different parameters that we have in portfolio return, and we saw that how we can apply this CAPM model to our portfolio in order to see how our portfolio returns look like, right? We can use this as I can change these stocks to any stock and I can see how it has performed vis-a-vis the market or the index of the market. So that is how we basically, so this is a basic calculation. Now there are multiple different mathematical complications also that we use in this portfolio, but we have tried to keep it simple and for all to understand. Any questions so far? No questions? All clear? All right. So let's, I hope you have got something. So let's move on to the next exercise for today that we have uh, that we have seen or we want to use. Now, let's talk about a scenario. Yesterday, we were talking about adding our constraints and our to create our portfolio weights. So let's revisit our constraint and our objectives and see some other types of constraints and create some returns and a risk of some other types of portfolio. So we will initialize our library correspondingly. And again, our library looks almost the same. Quant mode, the default package that we bring in. Performance analytics. The next that we want to use is ROI. And the next that we want to use is XTS, which is the extended time series. So these are the four libraries that we want to use. Now, we will use a data set from that is available in R, which is available inside R, which is called as EDEC. So it has the data of few securities in its in itself. And so let's look at how that securities look like. Let's see, it has everything. So so the types of securities: convertible arbitrage, CTA, global distressed securities, emerging markets. So these are securities related to these areas that data has in R. We will use this data for our analysis this time. I wanted to show you that even R has some data for financial analysis, and we will be using some of these data in order to do our analysis. Um, so let's basically these are the returns. So we'll store that in a variable called as returns, and the data that we want to use is something called as I said, edec, and I want to use from columns 1 to 4. So not 1 comma 4, it should be 1:4. So let's run and store this. So you can see your return dataset is created for your edec data, which is showing in the form of convertible arbitrage, CTO global, distressed securities, emerging markets. So we have brought in the data in it is actually in our environment itself, so no need to. So we are not using anything called as our auto assign and all of that. So because it's in our environment directly. Now, if the fund names, let's rename our fund dot names is what we will say as store the column names of our edec data, of our returns data. So column names of returns, I've stored it in my fund names. We will create our portfolio specification, spec. Portfolio.specification. So we know that before adding any constraints and objectives, we create our portfolio object. Our portfolio object is nothing but comes from all the fund names that we use. So when we initialize our portfolio specification, it okay, we have not run this. Fund dot names is basically and let's run this also. Okay. So we have created a portfolio specification. So by default, it has assigned weights of 0.25 each, 25% each, and we have created a portfolio specification. So initially, the portfolio will have we had 4 assets in our portfolio. You remember, which were the convertible arbitrage. There are others also, but we had used the first 4, which were the convertible arbitrage, the CTA global, the distressed securities, and the emerging markets. So we have created our portfolio specification, and it has initialized the weights to equal weights. Now, as fund managers, our main idea is to create the constraints and objectives in our portfolio specification. So let's start adding the constraints that we had done it in our last lecture, if you would remember. So the function that we use is called as add dot constraint, which is part of our performance analytics package. And the portfolio that we want to use is called as the portfolio equals to pspec, the initial portfolio, and the first. So this time, what were the different types of constraints that we had. The first constraint that we had was called as the weight sum, right? So weight sum, what it does, it gives you the option to define what is going to be your minimum and maximum weights. Now, let's say I give min underscore sum equals to 0 and max underscore sum equals to 1. So my portfolio weight will range from 0 to 1. The next type of constraint that I want to give, add dot constraint. The next constraint that I want to specify is called as my, again, we have to initialize our portfolio. Our portfolio equals to P spec. And the type I want to use is called as full investment. So I want to invest my entire amount in my portfolio, right? Let's just keep seeing how many types of constraints that we can add. Another constraint that I want to add is called as dollar neutral. I'll just copy it so that I don't have to write it every time. Let's call it dollar underscore neutral. So I don't want external factors, external markets to not to influence, means it need not be necessarily depending on dollar value for defining my returns. Another constraint that we can use is called as active. Now, there is one more type of constraint that we may use, which is called as a group constraint. Means as a group, I can define a groups of in my portfolio. Let's say one group, another group, and I can define what is going to be the min and the max weight for my one group and min and max weight for my other group. So let's see how we can add that constraint also in our portfolio. So that constraint is basically, again, I will use, in this case, the type that is will be used is called as group, right? And then the values that we have to pass, other parameters that we need to pass here, because we are using groups, so we have to define our groups, right? So groups equals to list. Now, let's say I want group A and group B. In group A, let's say group A, I want to create group A. Let's say I want to create group A and I want to pass my first 3 securities or stocks in my group A. In my group B, I want to pass the next 3 securities, right? The next we have only 4 securities, so we will always have this thing. The next thing, the next parameter that we want to be passed generally is called as group min and group max. So group min, we will define it by 0.1, and the other min that we want to pass is 0.15. Right, and then I pass the group max. So basically what I mean is the minimum of my groups cannot, of my first group will not be less than 0.1, and the minimum of my second group will not be less than 0.15. Similarly, I have to define the group max. So group max, I will define it as, let's say we define 0.85 for my first group and 0.55 for my second group. So I have actually defined my groups in this way. So if you see, I added the constraint and then I defined the groups that we had in our portfolio. So let me see the number of brackets that we have used. Group C, list, group A, group B. Group B equals to 4. Here we can directly use 4. Closing bracket here. So this is my list, group A and group B. Group minimum on this will be reduced. Now let's see if each one of these constraints get added to our portfolio specification. First constraint, it gets added. Let's see the next 3. This says, oh, this spelling is wrong. Let me run some. Okay, very well. We have got what we needed, right? This is not what we want. So we have added every other constraints to our portfolio. Let's add this constraint also to our portfolio. Again, constraint spelling is wrong here. It's not. All right. So my group portfolios have also been created. So right now my P spec is what it is showing initially. Let's see now another type of, now let's see all the different types, or we will add all the different types of constraints that we have. There is another type of constraint which is called as the position limit constraint we have seen. So let me add that constraint also. So the other type of constraint that we have type is called as position limit. And we have to give max position. It's 3. So we have added the position limit function parameter for this group also. The next thing that we want to add is the position limit function for our the next constraint that we want to add is the diversification constraint. The type is called as diversification. Diversification, as this term means, how diversified is our portfolio. Here we have to give something called as our diversification target. We have added quite a bit of constraints to our, then there are other type of constraints, like we can give the constraint on and the transaction cost, that so every portfolio before being bought and sold has a transaction cost. So that constraint also we can specify in our portfolio specifications. Similarly, we have a lot of different types of portfolio. Now let's see some variations of our objective function. So we can say add dot objective. In this, we can say again for portfolio specification, portfolio equals to spec, and then type, want to give it as return, and name equals to mean. So this is the objective function that we have seen in our last class also. So this is one of the objectives. We have to maximize our returns, which is basically defined by our mean. Now let's see some variations in this. Let's say our risk budget there is a different type of an objective. Let me add it, which is called as add dot objective. In this objective function, we will use something called as type will be risk budget. So there is something called our budget also, which comes under the purview of objectives. So name, let's say name is called as ETL. Generally, we call it ETL. And the arguments that I pass is something called as, like, let's pass the arguments in this case will be as a list we will be passing, where we passed basically the confidence interval, which is the p-value, right? And what is the other thing that we pass? Max underscore risk is equal to 0.3. So let's add these other constraints that we had or other objectives that we had. So you see that it got added. So this also got added. So similarly, we have different other constraints that we added, right? Now, let's create some random portfolios. So the methods means out of these constraints, we can create some random portfolios, right? Um, so the way that we create our random portfolios are, so they will have different combinations of these risk and objectives and constraints. So the method that we use is called as random portfolios, and the parameters that again we pass is called as the portfolio specification parameter. And then the other types are to give the number of permutation and combination. Permutations is equal to, let's say, 5,000. And method that I want to use, there are three methods. One, the first method that is being used is called as the sample. I will use the same for this. The next method that I will use is called as the simplex. I only thing is I want to create a different portfolio, right? Here also I want to create a different portfolio. And the next method that is available to us is called as the grid. So now let's define our three portfolios and let's see runs. Must be a finite number. Did I say that? I didn't have this. Permutations equals to 5,000. Optimum equals to sample. So have one. Random portfolios we are creating, right? So we have to define it once more. At heck 1,4. And here we have to give once more this portfolio dot spec, and we have to give assets equals to column names of R. This is what we need to give portfolio. This will be portfolio dot spec assets equal to column names of R. This we have to redefine. Okay. Now I think now it will be working. Okay. We have to pass the constraints. We didn't pass our constraints. Let's pass our constraints here. Okay. Now create a random portfolio. Must be there is I think the let me pass the uh, two constraints that we have here. These constraints are not the very right constraints that we are using here. Let me add it and create a random portfolio. So basically, the type of constraints depends upon you have to define based on the type of methods that you are being passing. So if you see RP1 got created, right? Now, if you want to view RP1, it created its own random portfolios. Now let's see. Okay, I think it's view. Okay, so it's double it. So if you see, it has assigned some different definite weights to means different portfolios combinations that it has used. So that is how you can use your constraint and your objectives combinations in order to create random portfolios for your method basically, right? And the different random portfolio methods available to you are sample, simplex, and grid. Okay, so this is just I wanted to introduce you to the different types of constraints, random portfolios that you might get to create. But this completely depends on your viewpoint, like what type of constraints you want to use and what type of data you have. Based on that, it all depends. So you will have to do a lot of, generally people do a lot of permutation and combination in order to get to the right values, right? Like the way which we saw, some of the constraints were not working, some of the constraints did work. So we have to see how the different things work. Anyways, so that was an idea to basically introduce you to the world of constraints and objectives and how it is being used across. The next important topic that I want to discuss is something called as the backtesting. Now, what do you mean by backtesting? So let's say what we have been doing so far is like we have tried to calculate the weights using the constraints and objectives by considering the stock prices over the entire time period, like all the way from 2000, in the CAPM formula we used all the way from 2016 all the way down till today. We used the same the entire time period as one block chunk of data in order to model our scenario. Now that is now in backtesting, what we happen is we divide that time period into multiple different phases of time. Let's say I define 2016 as one different time period, 2017 as one different time period. And I can define like how I even can say number of days as one time period. Let's say number of 5, 10, 15, 20 days as one time period, and so on and so forth. And we can create our rebalanced op. For each time period, we will use different constraint and different objectives to achieve a particular weights for the portfolio. And we will rebalance, keep on rebalancing to optimize overall portfolio. So that is kind of a very complex phenomena where we are trying to see different time periods data, use different type of constraints, use different type of objectives to get to the right weight that is needed for our portfolio. Let's briefly and see simply like how we implement a phenomena like this in our environment. So we will be using the libraries. I kept them, performance analytics, and let's keep them in this environment. Another library that we want to use is called as portfolio analytics. And let's define our tickers. Facebook. I will use the same tickers that I had. Actually, let me copy it from my previous. So the tickers that I want to use are called as the Facebook, the Apple, the Amazon, Netflix, Google, Sequoia, and Nvidia. So these are the different tickers that we had used. Now uh, let's let's get our portfolio prices also, like the way we did it last time. So this is from our last lecture itself, right? Portfolio prices, and I then binded each of my portfolio prices um, to my current data, and I'm getting all the way values all the way from 2016. So let's run our entire library. First, let's because not found. Hmm. This is there is one more. This is, it got created. I have my portfolio prices all here. Now what I want to divide is I want to create optimum optimal rebalanced portfolios. So let's go ahead and see how we can create automatic rebalanced portfolios. So the first thing that I want to do is create our portfolio returns variable, and in this I want to init automate portfolio prices. So I created my portfolio returns. Now the important thing comes where we define our portfolio specification. So portfolio.spec, and let me add the constraints from our previous section itself. Um, Column names, portfolio returns. Right. So I have my portfolio returns, I have my portfolio prices, portfolio returns, and everything. So I can just go ahead and run it. So my portfolio specification is created. Now let me add the two constraints. I will not type it. I will just use it from my previous session that we had used. If you would remember, we had all these constraints. If you remember, in this case, the minimum sum that I'm using is 0.99. Let's say minimum I want 99% of my investments to be invested in one of these securities, and then I am giving the minimum the transaction. This is another type of constraint that we use, which is called as the transaction cost constraint, which is basically the brokerage percentage, or for each transaction the amount of cost that you are incurring. So you can limit that also. The type of box constraint, you add your objectives and functions. So let's add all these objectives and functions and constraints to our, so they got added. Now let's see how we will create our. Now you remember we created our random portfolios in our last class. In our last test. So let's create our random portfolio here using these methods. So the method, if you would remember, the method we had to call was called as random portfolios. In random portfolios, we pass the portfolio specification and the number of times permutations it's going to happen, and the method that you're going to use, which is called as the sample. Let's create it actually. It takes a bit of time because it is doing a 10,000 round of uh, permutations in order to come up with different portfolios. So it is basically using these constraints. It is trying to take different permutation and combination. The program is trying to use different type of combinations. For example, you have some conditions based on which you will have multiple different type of permutations, right? So if you are given 10 numbers, you can select it in how many ways? 9 factorial, 10 factorial ways of selection. So that is the permutation. So in this, it did 1,000 permutation, 10,000 permutations using the given constraints and using the given objectives that we had. And it finally created our randomized portfolio. So if you see our randomized portfolio looks something like this, which will not be very similar to your original portfolio. Right, original portfolio returns will be something different, and your randomized portfolio looks something like this. So basically, 3, 4, 5, 6, 7. If you see, all these are different weights that have come up. We will add up. There will be minimum 0.99 and max up to 1.01 because of this constraint that you had given, right? We had given the minimum portfolio constraint as 0.99, maximum portfolio constraint as 1.01. So you had all these different combinations of your portfolio in order to come up with different portfolio combinations, right? Now let's so we have created random portfolios. All these portfolios essentially are giving you what it is saying is giving you a return which is um, for a given risk. It is giving you the optimum return. All this, so many portfolios it created. Now what we want to do is we want to create a optimum portfolio. We want to see what is the most optimum portfolio out of these, right? By you, so what will happen is all these different random portfolios that we have created will be tested against different time periods in all the way from 2016, and we can define the time periods, the rolling window, the months maybe, and each one of those portfolios will run against all those different combinations to come up with the most balanced portfolio. Now let's see how we could do that actually. So optimize.portfolio is a method that we use. Um, Optimized.portfolio was the method that we use for creating optimized portfolio for single returns. Here we will be using something called as rebalancing. What we want to rebalance portfolio returns, right? Portfolio returns we want to rebalance, the portfolio specification we want to give, and let's give optimized method. Optimized method equals to sample that we have given, we have been seeing random. Optimized method is random. The other thing that we used is RP. So that is our random portfolios, all the random portfolios. Now we want to give how, whether we want to rebalance on months, or we want to rebalance on days, or we want to rebalance on year, right? So means whether we want to run all these weight combinations against different months or different years or daily, everything you can do. Let's say the training period we define as 1, and let me say a rolling window is let's say 10, means every 10 months I want to say. Here we want to give another important parameter called as this. In order to run this,
Ranvesh sir,
yeah, hello,
I'm sorry, but your screen is not showing.
my screen is not showing.
Yeah, I think it is by default. Screen sharing is stopped.
It's saying you are sharing screen. Interesting. I will
Mansi ma'am,
reshare. I'll
Yes, sir.
reshare.
the screen is showing.
Yes, sir.
Okay, then it's some issue in my screen. Okay, please continue, sir.
Oh,
Sir,
right,
screen is visible, sir.
right.
Okay, okay.
Yeah. Okay. Yeah. So if you run, so I was here creating the optimum rebalanced portfolio, right? So all these different weight combinations will be run against different months, and we are taking 10 months period as uh, for one, let's say for one portfolio for 10 months, we are taking a period of 10 months. Every 10 months, for each one of the weights, random portfolios that we had, right? We see how many 69,993 random portfolios it created, random weights it has generated, which uh, adhere to all these constraints and objectives. Now, all these 69,993 elements will be run against the time period all the way from 2016 till today, with a rolling period of 10 months. And imagine how much time it is going to take. Let's limit it to search underscore size. Let's say I will say 1,000. I won't increase it. So let's say still this will take a lot of time to run, but let's run it and see how much Optimus rebalance portfolio it is going to. So this is going to take a bit of time, I think. It's pretty intensive. Yes, so I will let it run and hopefully it completes. Meanwhile, let's discuss few more aspects of Quantfin in general, right? Like, so um, We have seen the different results from the CAPM today. We have seen the results from our beta and our the different beta alpha calculations, right? There is one more method in which now we have seen different ways in which we can get data in R. I am discussing something else. Meanwhile, I'm writing the program to run. Hopefully it completes if it uh, doesn't take so much of other time actually. Yeah, so I'm discussing a few more aspects of it. Mm, there are there are some other methods in which we can get data to our environment. So I wanted to discuss few of those actually. So for Indian, because we are in Indian context and we primarily will be dealing with Indian stock market. If we have to invest in or if we want to be so in order to get the data from Indian stock market, there are specific R libraries which help us do that. One of the primary R libraries that we use is called as NSE2R, which is the National Stock Exchange data that we get it, right? And the National Stock Exchange data that we get is pretty is of almost every means most of the well-performing stocks you will get it. We'll see a bit of that in our once this program finishes, or if it doesn't finish, let me stop it actually in case because it might be so it didn't create it right now. I stopped it, but this is a method you can. I will send you the code. You can let it run on your machine and let's see how much it may take, half an hour or maybe a little bit of time. Um, you see the different optimized portfolios, optimum rebalance portfolios that you are going to get. So this is one of the methods to get it. Now, I was discussing one other method with you on getting the data from NSA2R. So the library that we use is something called as, let's say, I'll use another. NSE2R. Now, once I run it, okay. Now, in NSE2R, we have so much of information in our from our Indian stock market um, perspective, right? Uh, we get a lot of data from the National Stock Exchange. We can get it um, using a lot of these formulas. So let's see some of this. NSE underscore index underscore code. Let's see this. Okay. Yeah. You see all the Nifty indexes. It's what is the last traded price? What is the change? What is the percentage change? So this is live data for you. Means without going to any site, you can just call this library and you can just get call a function in order to get what has been the opening, the closing, what has been the last traded price, what has been the percentage change, and related to that. Now let's say we want to see which are the top gainers for the last trading session. So we want to use a function called as NSC underscore stock underscore, let's say top gainers. All right. So you see, in the last trading year, which has been the top performers in our. So Cipla has, you see the important pharma companies like Cipla has given you the max return. Sun Pharma, which is pretty obvious in the terms of this COVID era, right? Hindustan Unilever, Techem, Tata Consumers, Wipro, Reddy, Doctors Reddy, again another pharma company, Titan. Interestingly, some steel companies also have given you good returns. Tata Motors have given you good returns. Interesting, because I think they have a shared dividend. That's why they are up in the top 10. So that is another important thing that you can see. Now let's see the stocks that have touched their 52-week highs during the day. Means they have, so let's say NSC underscore again, we have to use stock, something called as year high. Let's see, so which of these stocks have gained. Now we can see, okay, who have, so these all stocks have gained their year high compared to the last trading prices. So what I wanted to basically cover is, this is one of the very important libraries where you can get the data for your Indian stock, from the Indian stock market perspective, and you can apply the techniques that we have learned so far in our different uh, in all the different lectures, right? You can apply the time series techniques that we had discussed so far, the moving average techniques, the technical indicators that we had seen, the portfolio management technique, the different, how we combine, take different stocks from here and see how you can leverage, and what could you can directly see how, what will be your, let's say you invest 1 lakh, after 6 months, if that 1 lakh becomes 5 lakhs, you can actually make it 3 or 4 lakhs or 5 lakhs. So if you follow some of these rules very carefully, but it's not that easy. That 1 lakh also can become 20,000 or 30,000. So you have to be very careful in terms of your selections, and not always that the methods that we discussed give you the right results in the perspective that we have seen. But anyways, having said that, these are some of the ways in which we get the data. There is another very important source of data which we call as the Quandl API. Now let me see if we had the Quandl API in our in one of our discussions. Let me see. Yeah, I will just show you the code for that. This is the Amazon stock prices that we had discussed, the bands that we discussed. This is our portfolio returns, efficient frontier. This is our trading strategy. These are constraints that we added, right? Another place where we had added that these are raw materials stock prices. Yeah, I think no. Okay, this, I think we have not seen that. So there is a library called as your Quandl API. What was the so we have to generate Quandl. So let me show you the API basically. We can get a lot of financial data from there also, but that requires us to create something like we have to create a specific key by create means like we have to register. It is all free, but we will have to register it ourselves over there. The library that is called as library Quandl. Quandl. Now here, in order to use the Quandl API, we will have to use something called we have to create our uh, API key over there. Right? Means uh, we cannot use it directly in order to get the data. Uh, in order to get the data, we will have to use something called as we have to create an API key over there. So let's let me show you some of the methods in which we can get the data from there. I'm not creating the API key right now because of the shortage of time, but I will just show you how to use that method, and you can, during your time, you can use your that API key, you can use it. Let me show you. So once you install the package, first call is you have to install that package. You have to go to tools, install package, type in Quandl. You can see Quandl here. I already have installed, so I don't. So I just have invoked this library Quandl in my environment. From there, what you can do is you will have to pass in your key to there. Now let us say I want to get some data from there. What you can use, let's say my data, and I can use you can call the Quandl method, which is just this method. Let me run it first. So Quandl method you can use. So you can see Quandl API key will be there. First we have to use that API key, but some of the methods that we are use, like Quandl, let's say I want to get some data from wiki. So I can directly type wiki here, and I can get the data from wiki from let's say a start date or anything from any start date, or let's say I want to get the data for my Apple. So I can use, let's say the things I want to use is called the start date equals to, let's say I want to use 2016 0101. So this is how I can use the Quandl dataset. So Quandl is another way in which where we can you get the data other than the Yahoo Finance. Get symbols.yahoo was one of the libraries that we used. NSE we have seen to get the data for the stock market for India. We have seen there is another data set where we have seen which is called as the EDHEC, which we used in the last section to get the portfolio specifications, where we created the portfolio specification. Quandl is another source where we can get the financial data for your different projects, right? You will get a lot of documentations available. I'm just showing you some of the basic methods in which we get it. The other method which we use is called as Quandl dot table, Quandl dot data table rather, data table. So this is another method that we use. What I basically want to see is you can get your the main thing in financial analysis is you need to have your data which is very correct, which you cannot rely on some unwarranted source of information for your any analysis that you are trying to do. You need exact data, and you need to know from exactly where you need to source those information in order to apply different um, techniques and concepts that you have. Um, so I will. So I think I have covered most of the things that I have for this course, that I had planned for this course, and I'm open this session for any questionnaires.
Participants, if you wish, you want to ask any queries from Ranvesh sir, so please ask right now.
Yeah. So if you are more interested in quant finance, you can I can give you information on the type of books that you can get in, the type of uh, more than I'm pretty sure you will need more information on more hands-on practice in R in order to be more.
Yes, sir. And definitely it would be very beneficial for us, sir, if you can provide the names and authors of some books. So parallelly, our participants would benefited at large. So if it
Right.
is possible, you can mail us or type
I
here
will
in
send a
chat box.
mail on
Yeah.
on the books and other reference sources that you can.
Right, right.
Mm,
So participants,
yes.
whatever books names or reference sources, sir is going to send us. We'll
I
share
think car
same in the.
bantu. Siddharth, car bantu. Sankhya car. Nam Innova ತರ ಕಾಣಿಸ್ತಾ ಇದೆ.
So we will share the same with our participants.
Yeah. So cool. No questions right now?
Sir, because these topics require, hands-on practice also,
Yeah,
and also
lot
these
of
things
things.
cannot be learned like fully on, 3 days workshop. But
Yeah.
still, since you have explained wonderful and very elaborate way. So, but still to have queries, I think we must do more hands-on practice after this workshop as well.
Yeah,
And for
it
that,
will
we keep
require that.
on doing also because, after a gap of 7 to 10 days, we keep on forgetting.
Yeah,
So that
that is
practice
absolutely.
needs to be maintained because then only we will be having, we will be in the position to ask more queries.
Yeah, absolutely. It is it requires a lot of
Because we
practice
are
hours.
at the beginner level and you are the expert of this.
I will also not consider myself very lot of expert because there are market there are lot of people who
Yeah.
actually make very good.
Yes.
There are some experts they have devised strategies which
Must be
never
yes.
fail. Yeah, but yes, you can say that we implement some of these in our workplace, and yeah, we get some results. We are we do pretty. Uh, our models are a little successful compared to many others. Also, I will say, yeah.
Yes.
But we have not. I have not gone into the actual modeling. Just given you a brief on how the models start getting created.
Right, right, right.
So yeah,
But
means so yeah, this is more about it's a very intensive topic. It's a very vast area. It's because it's entirely about the entire financial services industry, and
right,
it's how it has behaved, how the market has behaved. If people knew everything about the future and the stock price and all, they would have
right,
nobody
right.
needed to work. Right?
Yes, yes, yes. And And every damn thing on this world, we all are interested in what is going to happen in future.
That is
That's
exactly
that.
what it is.
So I hope, sir, I think there are no queries from our participants as such.
Yep. Right. In case you have, I'll give you my email address later on if any one of you need some information. They can send a direct query to.
Yes, definitely, sir. We will share your mail ID with our participants also. And yes, we got in chat box also.
Yeah.
So as and when required, we keep on bothering you, sir,
Yeah.
in future as well.
Yes. Thank you. Thank you, ma'am.
So thank you so much, sir. And,
Ranveer, for screen sharing, you can stop it.
Okay. I will just stop.
So thank you very much, Pranvesh sir, for sharing wonderful knowledge related to portfolio management, related to financial management, and how to use these databases in R. I hope really all the participants are really benefited and there is a real value added. Not only for this workshop, Pranvesh sir, thank you very much for sharing your knowledge time with us in all 3 STTPs, and in detail you have explained. So thank you very much from the bottom of heart. And it is a thank you very much from all the on behalf of all the participants, on behalf of IPS Academy, IBMR, and it is also on the behalf of AICT. Thank you very much. I hope sessions are really fruitful and participants have enjoyed, and there is a real value addition. Dear participants, if you would like to say anything, you are most welcome. No? Okay. So once again, thank you very much, Pranvesh sir. Dipti ma'am, hand over to you if you want to say something.
thank you, Sachin sir. And once again, on behalf of entire organizing committee and IBMR IPS Academy, Pranvesh sir, thank you so much.
Thank you.
And we look forward for sessions in futures as well. Thank you so much.
Shall look forward. Thanks. Thanks, everyone.
And dear participants, tomorrow it is going to be our day 6 and last day of our STTP. And tomorrow we will be having resource person from SP Jain Institute of Management and Research, Dr. Vinay Goyal, and he is going to share his insight on how to publish good research papers and how to identify good and worthy journals. So he is going to with us at 10 a.m. sharp tomorrow. So tomorrow there will be only 2 sessions of him, Dr. Vinay Goyal sir, and after lunch break, you people are going to have your assessment test, and the details of assessment test will be shared tomorrow. So make sure tomorrow you all join on time, sharp at 10 a.m. Thank you so much, everyone. Thank you.
Thank you.
Thank you, Sachin sir. Thank you.